Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. August 25, U.S. Market Review and Sector Analysis. This video presents a direct informational narration of the source document. So, diving into the August 25 market overview, the source document highlights a tech-led market rise alongside an easing of Middle East tensions.
Let's kick things off with a massive Monday trade on the GLD ETF. It's pretty wild. Someone executed a trade selling 116,000 September 18 call options right at a $420 strike price. That single move generated approximately $202 million in premium. But they didn't just stop there to collect that premium. To complete the mechanics of this 420 to 430 call spread strategy, they simultaneously bought $430 calls for $144 million. This leaves a net result of about $58 million in premium. What the source document points out here is that this is essentially institutional capital, betting that gold's recent 15% August rise is going to stall out over the next 4 weeks. That's a really sharp contrast to the fervent bullishness we are seeing from retail investors.
Moving over to equities, the broader market is finding its footing, with the S&P 500 officially reclaiming its 5-day moving average. Right now, market anticipation is completely locked onto the upcoming July PCE inflation data. But let's be real, the ultimate catalyst everyone is holding their breath for is Nvidia's post-market earnings report. Now, looking at positioning, a Citi strategist observed that long inflows are actually weakening globally. Exposure to the S&P 500 and the Nasdaq has basically drifted back down to neutral. But here is the catch. Russell 2000 longs are sitting right near a 3-year high. That definitely poses a potential risk if sentiment suddenly shifts. And speaking of sentiment and hype, the Wall Street Journal just reported on an AI startup pitching IPO investors with a theoretical market size that is just staggering. They are claiming a total addressable market, or TAM, for artificial intelligence that exceeds $30 trillion. Yes, trillion with a T. To really put that theoretical $30 trillion figure into perspective, the source document contrasts it with hard fact-set data. Last year, all 191 technology companies in the S&P 1500 index generated a combined total of only $2.4 trillion in revenue. So you're comparing $2.4 trillion in actual, realized sector revenue to a theoretical $30 trillion pitch. But that AI narrative is having real, tangible effects on the market right now. Post-July 23, we've seen a noticeable capital rotation out of semiconductors and into software stocks. This was largely driven by strong earnings from Microsoft and Intel, which sparked a complete narrative shift. Instead of worrying about AI disrupting software, the focus is now on how AI is redefining software workflows entirely. Within that software space, though, you've really got to watch the forward guidance. Take Intuit, for example. They had a solid Q4 earnings beat, but then they spooked investors by issuing weak guidance for fiscal year 2027. They cited a slowing consumer tax business, specifically TurboTax. The market's reaction was absolutely brutal, resulting in an over 14% drop in post-market trading. With that stumble from Intuit, focus is rapidly shifting to Salesforce's upcoming earnings. The stock has already rebounded roughly 46% from its June lows, yet interestingly, its valuation is still sitting near historic lows. Shifting gears over to the robotics sector, the source document highlights a specific robotics concept stock that announced a maximum $12 million Class B common stock repurchase plan. The market instantly treated this as a major catalyst, driving a massive 21.6% intraday surge in its share price. But if you look closely at the caveats explicitly stated in that buyback announcement, the company is actually not obligated to purchase any specific number of shares at all. Furthermore, the board can modify, suspend, or terminate the plan at literally any time, and absolutely no prior notice is required to investors. Back on the infrastructure side of the AI boom, utilities like VST and CEG remain incredibly resilient AI infrastructure plays, simply because of the immense power demands involved. Meanwhile, on the hardware side, Broadcom's technical trend remains highly bearish. The source notes that Broadcom has actually lost its 200-day moving average, as well as its 0.618 golden ratio. We're also seeing some severe structural hits in the retail space. Dick's Sporting Goods just had a massive earnings miss. Their full-year adjusted EPS guidance was absolutely slashed. They brought it down from the market expectation of $14.28 all the way down to a new guidance range of $11 to $12. As you might expect, that severe guidance downgrade caused Dick's Sporting Goods shares to just plummet. They dropped a staggering 30.7%, indicating incredibly intense selling pressure across the board for the stock. Finally, the source document notes a remarkably successful $5.75 billion convertible notes issuance. This was actually upsized from an initial $4.5 billion plan due to demand, and all of this capital is specifically designated for data center construction and GPU procurement.